questions regarding this solution? Right, so you see that the rates are slightly different. Right, so this rate here is slightly higher. And the reason for this difference is basically the difference in interest rates. Right? So you have to look at where do I have a higher rate. Here I have a higher rate in US dollars than I have in euros. Right? 0.1 is slightly above 0.7. So that's why the US dollar exchange rate is higher than the current exchange rate. The forward exchange rate is higher than the current one. Right? So the forward rates go in the direction where you have a higher interest rates. I think that's still the case. So the European rates are still lower than the US dollar rates. They both went up quite significantly. I think I looked up more recent numbers. So when I looked this up the last time, we had roughly 4% in US dollars. And 1.7% in euros. So the difference between the current exchange rate and the forward one will be much larger then, but still it's the same direction. Okay, so let me show you some actual data where you can find it if you are interested in this. So this is data from Eurex, which is a subsidiary of the German Stock Exchange. It's located in Zurich, and here you can trade basically derivatives on the kind of German market, Switzerland, Austria, and Germany, the German-speaking area. They have a couple of stock or equity derivatives and quite a lot of, like for example, the DAX futures will be traded here. And also foreign exchange and options. So they're traded globally. I mean, you could go to the US, like the NYMEX, have different exchanges. So this will be the ones that you would probably have as private investors here the best access to, since it's a German corporation. So what information do we find here? We find the current underlying price, which is the current exchange rate, 1.03. And then you will find in this table here a list of maturity months, the delivery months, right? Starting in December 22. Then you have like monthly, for the current year you have monthly quotes for the next months, and then it starts to get quarterly, I think. And you can trade out the longest one will be for delivery in June 25. And then these columns here don't really matter, but this one here is the important one that has the prices. So you see the rates are increasing here with maturity. Right, so still hinting towards that the fact that the US dollar rates are much higher than the European rates. And if you want to trade here in June 25 for the longest maturity, you would have to pay 5 cents in US dollars more than the current exchange. So where would you use this? For example, if a corporation is kind of trading or selling their product internationally, maybe let's look at like German automobile producers. I know that Daimler, for example, has their own currency trading desks, so they hired their own trader to do that for them. They're selling cars globally, and of course the selling price will be in the local currency. But the production is usually either it's in Europe or whatever nation that is. It's not scattered around the globe. So they have that cost in one currency, but they're selling the product in another currency. Right, so what they could do, of course, is if they do cost-based pricing, they could always convert their cost to the local currency, right, and then see, okay, how, and then they add up their profit margin of 20% or whatnot. and then kind of have kind of fluctuating price quotes. But that's kind of for customers very difficult, and you don't want to start like your customers waiting maybe 1 or 2 weeks because the foreign exchange rate is favorable to them. So you want to basically have a stable price in the country. So what can you do is you can already kind of convert the cash flows using the forward contracts. And you can kind of plan that quite reliably, like how much cars you're selling on average, forecast how much cars you want to sell. And then you can convert everything into one currency, you get rid of the currency fluctuations, and you can do proper price planning. And at the end of the day, the management of Daimler is paid in euros. They're a European company, so they want to produce a profit in euros. Right? So if it was an American company, they would like to present everything in US dollars. So basically what the Daimler does is they transform every cash flow they have, no matter where it is in the world, in a euro cash flow. And then report that number to investors. At the end, the dividend is paid in euros, the stock is traded in euros, and so on. Okay. Any questions regarding this type of contract here, foreign exchange forward? We're going to meet some more currency-related contracts in the next chapter. I switched a little bit the order of the chapters, so the next chapter will be on fixed income products. I think it makes sense because many of them are related to this here. And there will be another product where you can exchange cash flows from one currency in another one. It's a so-called swap. And it will work in a similar fashion, but it's not just a single cash flow here, but it's multiple cash flows that you can transform at once, basically. So if there are no further questions regarding this, then let's move on. So the next topic would be to explain you the difference between forward and futures contracts. I've already mentioned the key difference is that the forwards are basically customizable. They're traded bilaterally between two parties, and the futures are going over an exchange. Right? So what I just showed you on the Eurex that were futures contracts. They're usually standardized. But there is another difference that we briefly need to talk about. And to understand that the impact of the difference will not be in the price that you pay. Under the assumptions that we take here and make in this class, the price for forwards and futures are exactly identical. However, there's one thing that will be slightly different, and that is the so-called value. So for forwards and futures, we have to distinguish those two concepts here, the difference between the forward price and the value of the forward. The price is the price that you agree to pay on the delivery date. It's something that's fixed, right? It's like a product, property. It's a characteristic, and we've solved this problem last week and in the homework how to compute those prices. The value would be basically the present value of your profit and loss that you do from the trade. And very simply, at the beginning, when you enter the transaction, because you need one buyer and one seller at the same time, the forward price was determined in a way such that it is kind of fair for both sides. Right? Fair for both sides means nothing else than saying that the value for both of them is zero. Right? So the expected profit and loss that they make is zero. That's how you price it. That's why there is no cash flow today, because the value of the contract at the beginning is zero. However, that might change over time when, for example, in our last example, the current exchange rate changes, and it will be, of course, beneficial for one of the two. So one makes a profit, the other one makes a loss. Right, so I'm going to show you how to compute the value here over time of a forward contract, and that will be a key difference for the futures contract. So how can we think about this value or the profit and loss? Well, just think about, say, suppose you bought a forward contract, and the profit and loss that you make is the amount of money that you can make if you hypothetically sold it immediately at the current price. Right? So you observe a new forward price. Well, just think about, say, suppose you bought a forward contract, And the profit and loss that you make is the amount of money that you can make if you hypothetically sold it immediately at the current price.